Good afternoon, everyone, and good evening, good morning, depending on where you are in the world. Thank you for joining us. I'm Dave Roberts. I'm your moderator for today. We have a great turnout today. I just heard we have almost 2,500 attendees, registrants, which is fantastic. We have a lot to talk about, and we have fantastic panelists here with us today. The focus for today is the future of the hospitality industry, and there is a good case to be made for some cautious optimism, and I'm smiling when I'm saying that. That feels really good to say. We have fantastic panelists, and they're going to cover the future of the industry from a couple of different perspectives. We're going to talk about it from a consumer standpoint, as well as from the perspective of some major industry players like owners, operators, and brands. So with that, let me introduce our wonderful panelists and actually ask each of the panelists to introduce themselves very briefly. And let me start with Rachel.
Thanks, Dave. So I'm Rachel Rothman. I am the head of hotels research and data analytics at CBRE. We are the world's largest commercial real estate brokerage and advisory firm. And I am a proud member of the graduate class of 1995. And it is an honor to be here with you all.
And next up, Cindy, please.
Hi, my name is Cindy Estes Green. I'm the CEO and co-founder of Calibri Labs. We're a next-generation benchmarking and analytics company. We help hotel owners, operators, and brands evaluate and predict revenue performance. We've built the most robust database in the United States of hotel performance data, which is updated weekly directly from almost 35,000 hotels. I am also a proud graduate of the hotel school, and lovely to be here. Thank you for inviting me.
And last but not least, Jess.
Hi, everybody. I'm Jess Pettit, the Vice President of Analytics at Hilton. At Hilton, we've built the only fully cross-functional analytics team in the industry. So my team oversees across the globe everything from marketing, media, loyalty, pricing, new hotel development, and a variety of other areas of analytics for the company. And a really fun part of the business and gives a great purview to have conversations like we're having today. Also a graduate of the hotel school as well as my wife.
Wonderful. Well, thank you all for that. So we're going to go a little bit unconventional right now for a webinar. We're actually going to share some visuals. And I do want to emphasize this webinar is not about presentation. What you're going to see is some visuals, some information to set the context for our discussion. This webinar is going to be a discussion. Speaking of discussion, please feel free to use the chat function on whatever platform you're on and send in questions. They'll go right to eCornell and I'll see them, and we'll do our best to address as many of those as we can. So with that, Owen, would you mind projecting the first slide, please? And then Rachel, the floor is yours.
Absolutely. Thanks, Dave. Thanks, Owen. Owen, are you ready to switch to the first one? I want everybody to get behind why we can slash the word cautious from Dave's optimism slogan.
Love that.
Perfect. Okay. So this for me gives me the most hope, and it's just a quick big picture look at the relationship between GDP and RevPAR. And I know we can all get particular about seasonality and whatnot, but what I want you to focus on is the fact that GDP in the fourth quarter of 2020 was in line with the first quarter of 2019, and yet RevPAR dollars were less than half. If we look at our forecast for GDP for 2021, what you'll see is that GDP is actually poised to pass pre-recession levels this quarter. And so for me, that means it's a question of when, not if, RevPAR will recover. Let's take a quick look at the second slide. Oh, and that's you, my friend. Okay, here we go. Just since January, we've seen the consensus forecast for this year, 2021 GDP growth move up 140 basis points from 5.2% to 6.6%. And as we all know, there's a very strong correlation between the health and the economy and RevPAR growth. Oh, and slide 3. Okay, let's take it off the top line and let's take a quick deep dive into CBRE's proprietary trends database. which tracks the full P&L of over 7,000 hotels annually going back to the 1930s. On the left, what you'll see is periods of contraction in the hotel industry, and on the right, you see periods of expansion. In the boxes, you'll see flow-through, which is the change in revenue growth related to the change in gross operating profit. And what I want you to notice is that with each and every cycle, hotel owners and operators have become increasingly efficient in mitigating top-line losses into bottom-line losses and growing top-line gains into flow-through and gross operating profit. So that bodes well for where we are in the inflection point. Let's take a quick look at why you should believe me. Okay, Owen, let's go to the capital markets slides. All right, a view from the capital markets side. Next slide. All right, so it's perfect to believe me and why I'm optimistic, but let's look at the third party, the rest of the universe, and what they think about the future of hotels. Here in the top line in green, we have an overview of hotel delinquencies, those hotels that are more than 30 days past due on their interest payments. And what you can see is what was a peak of over 24% in May of last year has trended down to 16% currently. Yes, it's well above where we were prior to the pandemic in the ones and twos, but nonetheless, I'm encouraged about the overall direction of cash flow for the hotel owners. And my final slide. People vote with their wallets. Back in June, we had only 20 lenders in the market willing to lend to hotel assets and almost none willing to lend for new construction. If you look today, we have over 140 lenders actively engaged in the market, lending across all hotel deals, and over 40 lending for new construction. Again, people wouldn't put their money there if they didn't believe we were at an inflection point and cash flows were poised to rebound. With that, Cindy, I'll turn it over to you.
Thank you, Rachel. So what I'm going to do is a little bit of a deeper dive on the specific hotel performance. So if we can move to my first slide. And we're going to look at occupancy and average rate and the pattern from January of 2020. If we can, Owen, move to the next slide, please. This pattern reflects the downturn where you see that big dip. The red line is ADR, the blue line is occupancy. As of the week of April 2nd, we were at 54, almost 55% occupancy, and both occupancy and average rate are running about 20% down from 2019 levels. You can see that the trajectory of the line is now moving up finally. We had a period of sort of static period when the infection rates were spiking and things weren't looking so good, but we're definitely on an upturn, and it's being felt pretty dramatically across the industry. We're going to drill in a little bit if we look at the next slide, and we'll see a little bit of a breakdown of what that looks like. So in terms of growth, the two biggest growth in terms of demand drivers is the OTA business and the loyalty member rate or direct promotions. As of the end of March, OTA had started to kind of break away across the overall US. But if we break it out by chain scale, and I don't have those slides to show, I can just tell you upper upscale and upscale hotels actually were the reverse. The loyalty member rate and direct promotion business was actually exceeding the OTA business. However, what we see, because the demand is so dependent on the leisure side of the business, corporate and group is so much lower. That bottom line, the blue one at the bottom, is group. The pink line that you see is rack bar, which is still kind of the steadfast main portion of the business. But most of the growth, that's kind of flat. Most of the growth is coming from the leisure segments, which is the direct promotions and the OTA business. So we can drill a little deeper into that and start seeing some patterns, which if we look at the next slide, there is some interesting patterns that we saw, which I consider a silver lining. We separated, instead of looking at weekday and weekend, we separated shoulder nights, Sunday and Thursday. And what we found throughout, and this takes us from January through to, I think this is through February or March, we see that Fridays and Saturdays, along with Thursday and Sunday, are outperforming Monday, Tuesday, Wednesday. This wouldn't be a surprise because we know commercial and group business has declined so much. But when we see this pattern, which has persisted and continues to persist, a lot of this work from home led to travelers taking longer weekends because they could work Friday and Monday from a remote location. So the hotels benefited by longer lengths of stay, and Thursday, Sunday behaving more like Friday, Saturday, which means we have 4 much stronger days of the week, which really bodes well and probably will continue, I'm guessing, at least through the rest of the year. And that's a good sign. If we want to dig a little deeper, the next slide, we drill in to look at the real composition of demand. So it's one thing to look at RevPAR, but you really need to unpack it. The biggest thing that happened with COVID was the commercial side of the business dropped out. So that's whether it's group or transient related. The red and the blue line at the top represent the amount of business from the beginning of 2020, how that portion of the demand just shrunk. And the other segments, while they grew, could not totally compensate, which is why we were running much lower, 20, 30, 40% occupancies. That corporate and group business is really the determinant of how the recovery will play out. And minding that gap, we're kind of keeping track of when that business starts to come back, will have a really big impact on how the recovery plays out. And it will play out very differently in different markets and submarkets. So if we look at the next slide, we'll see we tracked 975 submarkets in the US, and what the number that you see at the top of each column reflects the number of submarkets that fall into each category. The percentage that you see at the bottom is the percentage that they will be, or an index against 2019. So by the end of 2021, we expect about 150 submarkets to actually be within 20% of 2019 performance levels. If you look at the other end of the spectrum, because it is a bell curve, there's about 150 submarkets that will still remain 50% or worse below 2019 levels. And then we have about 675 submarkets that are somewhere in the middle. So depending on how this corporate and group recovers and the pace at which it recovers will determine which of those submarkets can actually start picking up business faster. But it's surprising that there are so many submarkets that even by now are doing better than they were in 2019. But it's not consistent, and it's very dependent in each one of those markets on how much demand is dependent on the commercial side of the business. And then my final slide is a little bit of a forecast for by chain scale, and you can see, which kind of ties to the location types. From economy down to luxury, the economy hotels were in locations that were themselves less dependent on the commercial business. So the blue column represents the 2020 index to how they did compared to 2019 performance. And the economy and mid-scale were, kind of 75%, 65 to 75% of 2019. But if you go down to the upper tier, the upper upscale and luxury hotels, they were considerably lower. And when we look in the orange column, which is what we expect 2021 to be, the performance and the recovery will be similar. They will, at the economy end, will recover more quickly and get closer to the 2019 levels. And while the upper tier will improve, in the absence of that commercial business, it'll still be a slower climb back. So I will now turn over to Jess, who's going to talk to us a little bit about consumer behavior.
So to say that the last year or so has been turbulent in industry results is obviously a fantastic understatement. But what we do see, and if I want to flip the slide, what we do see is over the last several months, we see the light at the end of the tunnel, right? That we actually have, if you look at sort of industry standard forecasts, all of them really that have been released since, between November and January, the industry's far exceeded expectations over the last couple months, as much as 30 or so points in growth in March alone from an industry perspective. And that's a fantastic, sort of an initial sign. But what we've seen all along the way is today's performance does not necessarily indicate tomorrow's. And so we've seen those fast swings. We saw improvement last summer, followed by negative swing because of the pandemic environment in October, and then starting in late January again, we saw positive movement. And really what's most important from an industry perspective isn't necessarily the initial signs of growth we see today, but what do we see in the future? In 5 or 6 months from now, what is actually going to, what is actually going to be the trend as it relates to group and business transient? And so we look at 3 key recovery drivers as part of understanding that. First off is really the vaccination effectiveness and just overall rate of vaccination. That has far exceeded any expectation over the last several months for the U.S., but that's not necessarily the case over the rest of the world. UK and Israel obviously doing quite well. Canada, surprisingly, not as well. Canada has half the rate of vaccination, one-dose vaccination than the U.S. at around 20%, while the U.S. is at 45% of 16-year-olds and above. But net, it's still unbelievable to think about where we are now versus a year ago. We are seeing that sort of significant rate of vaccination, and hopefully what we'll see is several months from now that has proven to be effective, right? That's ultimately the biggest economic risk with all of this, is that it doesn't end up being effective over the long term. Second is, while we know and Rachel shared, GDP is expected to see fantastic growth this year, it has to manifest itself in corporate investment, right, and non-residential fixed investment. And the good news there is, the forecasts show that businesses are ready and willing to invest. They've gotten a lot of government stimulus. They've been able to save and mitigate losses over the last year. So when businesses spend, they travel, right? And so if we're in an environment where NRFI is expected to grow 7 or 8% this year, that should equal business travel coming back, right? You combine that with vaccinations, you hopefully can see, folks wanting to get out on the road. And then the third piece is customer sentiment and savings. And what we see is sort of post-election cycle plus vaccinations have led to consumer sentiment that's increased pretty significantly. And also customers have savings. The one economic metric last year that was really performing well was durable goods. Durable goods are things that cost over $1,000. Travel also costs over $1,000. Obviously, in that 6% of growth last year, they weren't traveling, right? They were buying other things that cost over $1,000, cars, refrigerators, whatever. And so what we see is with savings rates double what they were the same time in 2020, from January to January, is that there's a lot of money on the sidelines. And so customers are ready to get out on the road, and this revenge travel dynamic has the right sort of setup, right? If folks are getting back to work, if vaccinations are effective and safe, and people are feeling good and have money to spend, there's this chance for revenge travel to be a real thing. And I think we've seen the initial green shoots of that with spring break and the potential for hopefully a very strong Memorial Day. But I would still table that with the fact that what you see out of leisure today isn't enough to get us back to normalcy. We need all of our cylinders going, and that's where group and corporate transient are particularly important in what trends we see there. So with that, I'll hand it back over to Dave, and let's start getting into some questions.
Wonderful. Well, thank you all for sharing that. It was very interesting. A lot of information there, quite a lot to unpack. Let me start with a demand outlook, and I'll start with Cindy, but obviously Jess and Rachel chime in anytime. So we have significantly outperformed expectations in the near term, and the question is, to what extent can we extrapolate that to the future, or should we or shouldn't we extrapolate that to the future? We have good news now. Does that mean good news coming up?
Well, so as Jess pointed out, this uptick feels really good, and compared to what we had been through, it was so awful that it's just feeling like we're finally, picking ourselves up and getting going. But the industry depends on about 50% in the U.S. market. A little over 50% is commercially driven with the combination of transient and group. So that's a big chunk of business that just went away. And until the big corporate accounts are ready to put their travelers out on the road, whether it's for liability issues or because they've decided to cut travel budgets because they didn't need them last year, it's hard to know how quickly that'll happen. So I think that, our projections were for kind of 20% improvement over 2020. getting us close to like a $50 RevPAR kind of number. It could be better. I mean, this leisure boost and some of the silver lining I talked about, that's incremental business. That's actually business that didn't exist before. So we don't know how much of that'll be there, but it won't be enough to make up for the corporate and group. And, as far as groups, that's driven by guidelines in different, metro areas and states and so on, as far as how many people are allowed to meet. We are hopeful there won't be another wave of a virus, and hopefully that any of these variants will be covered by the vaccines that are out there. There's a lot of things we don't know. But that we are definitely going to be doing better, and there's so much pent-up demand. But we are so dependent on the commercial side of the business, especially in the major markets and especially at the upper tier, that until that business comes back for real, it's going to be hard for us to get back to pre-COVID levels.
Yeah, and Dave, I would just add, what we've seen, at least in the short term, is still, a nominal improvement in weekday business, right? Not nearly the levels we see on weekends, but, especially in places like Texas where restrictions have been lifted, you do see a related slight increase in typical business travel trends, right? And that's a good early sign. But I think this is where the term cautious optimism really has to come in, right? You have to believe a variety of things in order for September for business travel to return to the level that it needs to. You need to believe that businesses have the money to spend, right? And I think the data proves out that they do. You need to believe that they have the right health and safety precautions in place, which hotel companies like Hilton have really focused on, but businesses need to make sure they test and trust that, both for hotels as well as airlines and otherwise, right? So that has to help with the environment. And then you have to also believe that there hasn't been an actual change in how people want to do business, right? So we've all gotten used to doing calls like this over the last year. How much of that is stuck versus how much of it has just sucked? Right, and I think we can all say very, easily that this is not a fun part of what we do. But even if it's used 5 to 10% more, that's still something, right? And while we don't need to figure that out for the end of this year, because we don't expect demand to recover to 2019 levels at the end of this year, over the next several years, that I think is one of the ultimate challenges of our industry, is to continue to prove the value of doing these sorts of things face to face. As much as possible, which I know personally, and really it's sort of, I think, a quintessential part of being a hotelier is that it has to mean something, right? The human element is really why hospitality is so special and what we miss. So I'm a believer, but I do think it's going to take an evolution and potentially some form of a revolution for our industry to meet that need, when it really needs to come in 2023 and 2024.
Excellent. I want to follow up with you, Jess, on some consumer behavior. But before we do that, I want to ask Rachel, your process for forecasting. You take into account macroeconomic factors. How do you factor in assumptions about vaccine availability and adoption or travel restrictions? How does that factor into your forecast? How do you do that?
Well, the great thing is that I work with a gentleman by the name of Dr. Bram Gallagher, who's a PhD in economics. I am a PhD in econ dropout. So Bram runs circles around me, and I'm very lucky to have him, along with Robert, who runs our trends database. So I would think that we look at all the traditional things, but you are right. They have to put a base level assumption about vaccines in the model, what the pacing will look like over the quarter, when we expect herd immunity to come into play. Hopefully I'm correct. I think Bram had herd immunity modeled for July. And I know that the vaccines have been pacing faster than our econometric model suggested. That said, I think the big question that's open for debate is whether or not that just means the first half of the year is going to be better than we thought it would be, or whether or not that's going to lead to stronger business demand throughout the entire year. I would just add two things to what Jess and Cindy said. Obviously we haven't talked about inbound international travel and the role that that plays in the global gateway cities, like Cindy talked about, right? Some markets being more influenced than others or lagging behind more than others. So I think that's one factor at play. And I think if I were to have Robert here with me, also a hotelier, he would say, don't forget that profits can rebound faster than revenues, right? So we've had a tremendous amount of cost cutting this cycle, and there might be some work to dig into there. But just because we might be slow to recover fully from a top line doesn't mean that some of the strategies that have been put in place won't really help owners and operators accelerate on the uptick.
Wonderful, thank you. I want to get back to Jess on consumer behavior, and this is kind of a broad question, but consumers are behaving differently now in terms of booking their travel and in terms of actually traveling. What is going on with consumer behavior in that sense, and then how much of that change in behavior do you see, would you project into the future? Can you comment on all of that?
Yeah, and so I think there are a few, as we look back to the beginning of the crisis, it was really interesting to track consumer behavior, right? Because in a way it became very simple. Demand was so low, and it was only a certain type of customer that was really traveling to hotels, essential travel, crisis travel. And then, you could basically draw a radius around where somebody lived, and that was where they could potentially travel to. And so, as that sort of expanded through last summer, it made, understanding customer behavior actually quite a bit simple. So while customers were booking in a much tighter booking window, and we've seen a lot more folks that are booking on, 0 to 2 days in advance of their stay, it wasn't necessarily hard to predict where they might be going because they weren't flying, right? And so we saw a significant uptick in the amount of our business that was really drive to versus fly to, or at least the mileage that we saw them coming from. So you assume that they drove. And so drive-in became the vast majority of the business that we've seen, and that's still the case today, although expanding. And you're seeing much more. I just went on a trip to Hawaii. Many more folks are sort of expanding, especially as they're vaccinated. You're seeing sort of that window expand, but it's really interesting if you take that radius point that I mentioned, and we started, to the point that Rachel was saying before, we started tracking mobility data, so publicly available cell phone data to see how far people were willing to travel from their homes to go to the grocery store even, right? You see that sort of expand, and then they're starting to willing to go 120 miles. Now they're willing to go 400 miles. Now they're willing to go 1,000 miles again. It's really interesting to see how that's proceeded over the last several months. We've seen booking windows start to expand again, right? And that's certainly valuable to us as an industry. And because it's such a leisure-centric crowd, there are elements of this that sort of are part of being more of a leisure-centric crowd. More business comes from OTAs as a percentage of all of our business than it did before. That's not to say that OTAs are the driver. It's the customers were always there. It's just the pie got smaller, and that piece of the pie stayed the same, right? And so that's where you get to some of the red herrings in some of the customer behavior, right? It's really easy to read into it and go a little bit too far. And that happens as it relates to ADR too, right? You look at the industry data around ADR, and it's relatively devastating if you look at it just by itself. But when you think about who's staying at our hotels, the value-based customer heavily weighted towards economy and mid-scale travel, it's actually not that bad, right? If you account for how they would have traveled before. So I think, to summarize my point, there are some really interesting behaviors that we've seen sort of evolve over the time around distance and booking windows and loyalty versus non-loyalty. But there are also some things that have been interesting but complete red herrings and have been, can easily be overreacted to. And so what I think is going to be interesting as we go into the summer, we're still going to see some of those target markets that have performed well to this point, beach and resorts and national parks and all that sort of stuff. But I think it ties to Rachel's point before, gateway cities, which people have generally avoided, whether for international travel or not. When do people start wanting to go to New York again, or when can they? When can people start going to Chicago? in San Francisco, and I think that's going to open up a whole other window for both corporate and leisure travel that I would imagine will come up sometime, earlier midsummer, and really start to power the big box hotels that live in those cities.
Excellent, thank you. Let me take 5 seconds and commend you three panelists. You have certainly sparked the engagement of this audience. We have a flood of questions coming in, and I'm really happy to see that. There are several questions about, let's talk about the future of business travel. For example, this is sort of a question for all three of you. Will we see road warriors again? And then I guess related to that, another question about the work from home trend. And it seems to be a very extreme trend and extremely popular. How do you see that playing out? And then the impact of the work from home trend on business travel and possibly even on personal travel? Sounds kind of a broad question for all three of you.
Well, I can comment. I mean, my thinking, and we probably a lot of people read that Bill Gates article saying 50% of business travel will go away, which I disagree. But when you look at business travel, we never really thought about the segmentation of business travel. But you've got those that are attending meetings because they're meeting with clients or it's sales related. That's going to come back first because people can't stay away from their clients. So I think that sales related activities and activities related to anything client facing, account management and that sort of thing will be the first to come back. I think intra-company travel might be considered more optional. And if the CFOs of the world who like tightening their belt and cutting back on those travel budgets, I think that the intra-company travel where people from one company to see colleagues within the company will be the main thing that is suppressed. So we don't know the percentage that is. I mean, if it's 15 to 20% of it, I would contend that as the economy grows, we're going to absorb that. And I think that we'll end up back to where we were in terms of commercial volume. I just think the nature of it will be somewhat different. And I think that this work from home behavior will persist in a more hybrid way. Not that everybody's going to be doing every Zoom meeting, but to the extent that you can do meetings like that, you might do that. So some portion of your interaction will be like that. So people may come in the office several days a week, but they may not be 5 days a week, everybody in the office in the future. But the work from home thing has really helped us. This is this long weekend idea. If that creates incremental opportunity for leisure business combination kind of trips, that's business we didn't have before. And the other point I want to make to Jess's point about the movement toward OTA, one of the things we saw was actually a strong movement toward the direct promotion and loyalty member rate business. In spite of the fact that what I showed across the US starting in March was much more growth in the OTAs, that loyalty member rate direct business was very attractive to the consumer. It was equal to or greater than for most of COVID, the COVID period, the shutdown period, because consumers wanted to book directly so they could understand the safety protocols or understand what was going on and not be afraid that they couldn't cancel their reservation if they needed to. If the industry takes advantage of that and continues to make offers that are compelling, the direct business grew 15% last year compared to indirect, which was a really good positive thing. It brought the cost of acquisition down. So if we can continue to offer direct booking options and to continue to take advantage of those longer stays because people are working from home or able to work remotely and continue to do that, I think that is a really good sign for the industry. And I know Rachel had something to say.
Yeah, I just had 2 points to add and a little bit of an anecdotal story, but I've been remote since before the financial crisis, if you can believe that, almost, 13, 14 years ago. But along with that, I've traveled almost 100 days a year, every single year until we hit COVID, right? Because I always used to say to my boss, I'm working hard, not hardly working. And how do you prove that you're working hard, right? You have to be top of mind always. And I think that is what Cindy was talking about. If you're a sales professional or if you're in the front office type role. And I would say with respect to intercompany or intra-company travel, don't forget that to the extent people are remote, there is significant real estate savings opportunities, and that can be reallocated to bringing teams together on occasion. And I think we also need to look at the overall relationship between the cost of flights and the cost of hotel. Because I think what you might see not come back is that transcontinental flight that I would do 3 times in 1 month to have one meeting. And maybe you go once, but you stay 2 or 3 nights and you have all of your meetings in succession, because the flight actually is pretty costly. And it's a large portion of the overall travel spend. And I think that that's something that we might be leaving out here.
Yeah, good point.
Yeah, and I think the prediction of the death of business travel has come pretty much every cycle in some way, shape, or form, right? And what I'm reminded of is the power in a way of inertia. People like to get back to their normal lives, and I like to think that what we're doing right now is not our normal lives. What we were doing a year or so ago was our normal life. So it's tough to sort of speculate and imagine what it's going to be like 2 or 3 years from now. But I can tell you what I'm watching for is similar to with everything else in the crisis. There's a series of things that have to happen, right? People have to know that it's safe to come back to work. If we start to see office occupancies kick back up, right, I think that's going to be a leading indicator of travel demand, corporate travel demand, right? And before corporate travel demand comes back, we're going to see people go back into the office, whether that's 1 month in advance, 2 months, or 3 months. And you know, I have a feeling that it's going to come back pretty quickly this fall, and we're going to see some semblance of business travel. I think, you know, to Rachel's point, it doesn't have to look like it did before, though. In fact, a straw poll of my team at Hilton, you know, roughly 100 people, nearly 50% of those folks displaced in some way during COVID, right? That doesn't mean all of them are going to move back and live in the DC area, but it is going to create more opportunities to travel than they may have had in the past, right? And it's not just about seeing clients. It could be about more travel to get back into your office and more folks doing what Rachel may be an example of than we've had in the past. So we'll take something away, right? There's going to be something that's going to be different, but we're also going to be creating something new from a demand perspective. And I don't know whether they're going to offset each other, but I'm certainly not panicked. I think that there's reasons for cautious optimism that it's going to return in some similar demand.
I'm very much enjoying your optimistic take, all three of you. I appreciate that. We have a few more questions related to business travel, but specifically about meetings and events and the so-called hybrid meetings. Do you see that as a trend that will project into the future, or is that a temporary thing and we're going to get back to big meetings? How do you see that playing out? That's a question for anyone who wants to take it first.
Yeah, so I mean, I think it's critical that there's a hybrid meeting product for Hilton. Event Ready has been a big part of our strategy. Ensure customers feel good about being there in person, but also have an option to be there remote. I don't think there's any question. Whether or not that becomes a passing trend or not, I think it remains to be seen. There's technology that supports it, but no matter how good the technology is, it's not a great experience. I don't know that that's going to be a long-term answer. I think it's going to be part of the equation. But you know, the reason why you do some of these meetings in our industry, things like NYU and Hunter Conference, et cetera, the reason why you do those meetings is because you want to get together and do deals with people in person. And I have a hard time seeing how that ultimately gets replaced, no matter how sort of novel some of the technology solutions may end up being. And I do think they're going to improve, and I think it's never going to be seamless, but I feel like it's going to be part of the equation, but not as dramatic as it might be over the next year or so.
Well, but they're also, from the DMO point of view, I've spoken to some DMO leaders recently, and there's definitely the thought that, you know, maybe for deals and sales related activity at these shows is one thing, but a lot of them also have training and educational components. And sometimes the ability to bring people in where sometimes they rotate, where 1 year they attend remotely and then they want to go in person. We may be able to, there's a hopefulness that there'll be more people engaged, even if alternate years you participate remotely, to just keep people kind of in the cycle. So I think that I agree that technology will continue to improve. It'll never replace, client-facing activities like a sales or account management type activity. But I think there's a role for it. And I think if it means keeping people engaged in an association that conducts training or educational programming, where they can plan to attend a certain number of times. They may never have attended before because they couldn't afford the travel. Now they can go remotely, and maybe the second or the third year they can actually go in person. So I think the DMO community is hopeful that this may actually trigger more engagement. And that
it's an interesting point. I hadn't really thought about it. My wife, by chance, is currently doing her master's. We're at Northwestern. She's in many of her classes are hybrid, right? And frankly, the experience is dramatically different, right? It's a quality versus quantity type thing, right? I think, Cindy, you give a good example of you can increase the quantity, right? But I think the research is going to show over time, and Dave, I don't know if you have any hybrid classes, the research is going to show you don't learn as much, right? And there's a reason why teaching happens in person and it's far more effective. And I think it's going to be one of the most interesting, human costs of the last year is the loss of actual, in-person interaction in a classroom type setting. And I think that's similar to meetings and events is that it is just, you get so much more out of it in person. And if anything, it's going to prove the value of that over time.
Wonderful. Thank you. We got actually got a lot of questions coming in. Thank you to the audience for sending in your questions and being so engaged. Thank you to the panelists for sparking so much curiosity among the audience here. I want to ask Rachel about ownership, but before we go there, I want to ask. There's a couple of questions about segment level recovery and which segments are going to lead this. We've talked about leisure, we've talked about BT, we've talked about meetings and events. Any other broad comments about the recovery at a segment level or maybe a source level? There was one question about vaccine passports. Is that going to have an impact? Maybe I'll start with Jess on that, and then anyone else welcome.
Yeah, I can give a really quick answer on segment level recovery. Last April, we put together sort of our theory on how customers would come back to hotels, and I think it's actually proven out to be relatively accurate. You go from crisis and essential travel to leisure travel within a tighter radius to leisure travel in more of an expanded radius, but you're still primarily focused on beach resort and national park type destinations. The next round of travel recovery I do think is going to be leisure going to more urban type markets, and then you get into BT that's local BT before you get into your larger, sort of consulting type accounts. So localized BT sales accounts that are, traveling salesmen and women that travel around, in a reasonable radius. Industries that have been doing well, like healthcare, et cetera, you're going to see them start to travel. Then you're going to get to those larger corporate accounts. Group is I think going to start with social earlier this summer. I'm one example of, I did my backyard wedding, but have had to reschedule my wedding 4 times in the last year and a half. There are many examples of that, and there's going to be a lot of compressed social meeting demand that's going to be lasting through this fall. And then you get to, conventions, which will start as hybrid with a decent amount of conventions, but with a relatively small audience. That's going to expand over time. Corporate meetings then coming back, following the rest of corporate BT. So hopefully just kind of a quick synopsis, but sort of see each of those things kind of building up over time.
And one of the things we're seeing is within leisure, advanced purchase, AAA, AARP. Like AARP is going to start picking up because now the older crowd's been vaccinated, has a lot more comfort, can't wait to get back on the road. So specific types of business, government will come back before the traditional corporate. But I think that there are more components of leisure. And it's funny because I just had a meeting in the last couple of days with 2 different ownership groups, and they're definitely having to relearn their teams, the management teams are having to relearn how to deal with leisure business, because for most of them, they were if the whole U.S. was, more than half was commercially driven, except in the resort destinations, a lot of these hotels just don't have people experience. A lot of the salespeople are selling business transient. Now, all of a sudden, they have to learn about the leisure side of the business. So there's the travel agencies, a lot of them are actually booking, and I just had this conversation this morning. they're booking advanced purchase and rack bar and package and AAA. And it's like all the stuff that they hadn't really seen. So it's like all of a sudden the nature of the business is different because it's a mix of leisure for now. I think those small corporate accounts, I agree with Jess, those will come back sooner before the big corporate accounts. But I think that seeing the different elements of leisure is really important to really understand in any given market which of those are picking up and which ones to go after, because that government is going to be really valuable until we get the major corporate business coming back. And Rachel, I keep cutting you off. I know you got something to say.
All I was going to say is I got my vaccine, well, my first one, and booked 3 conferences in a row.
Yeah, and to the question on vaccine passports, it obviously heavily politicized right now, right? There won't be a national plan. There are some states that are adamantly against it, some that are adamantly for it. I don't know that it's necessarily going to make, at least from a government perspective, a big part of the equation. What I'm more interested in is how businesses handle it. And that's going to be, an interesting question, right? That do you have to be vaccinated to come back into work? Is that, legal in some markets? Do you have to be vaccinated to be able to travel again? What are the testing requirements? All that sort of stuff. I think it's too early to tell what some of the trends are going to be there. But there, likely are not going to be governmental answers towards vaccine passports. And certainly with the U.S., it doesn't appear there's going to be travel bubbles like there are between Australia and New Zealand.
Excellent. Thank you. We have a few questions coming in about management contracts, and I'll just make this point. I hope some of them are from my students because we covered management contracts in detail in my class. But let me turn this to Rachel. Do you feel like the pandemic has caused owners to think differently about management contracts and even about the structure of them or the terms or anything else that they're more focused on now than they would have been before? And anyone else welcome to chime in as well.
I mean, I guess the first thing I would say is, because it's a material adverse change, probably many of them are now able to renegotiate contracts that were considered fixed or switch management companies if they wanted to. And I think as a trend, you might see movement towards shorter management contracts if people are making changes, and stronger alignment between the top line growth metrics that traditionally many of the management companies are compensated on and bottom line profitability. So I think you could see them incorporate more metrics that align not just the top line goals, but the overall bottom line profit goals of the owner, which has been very customary for the large public owners, but not so much in the smaller franchised owners. And I think that you're going to see a migration in that direction over time.
Yeah, my experience with in talking to owners is there's going to be as much of a push toward more flexibility in general. So whether it's the duration of the agreements or the conditions of the agreement, a focus on profitability, there's no question. There's been a move before COVID toward trying to move much more toward profit contribution, which of course, from an owner's point of view, the flow through is kind of everything.
Maybe an owner's priority introduction in some of the smaller owners as well. I know that's also been customary for the larger public companies, but you might see some of that migrate to the smaller owners.
And just to follow on that thought on the increased focus on profitability, what about cost controls that are in place now? I'm thinking about things like more automation and reduced housekeeping. What about those? To what extent do you see that continuing into the future, or is that going to be kind of a bounce back to pre-COVID? And maybe, Rachel, if you start with that and anybody else chime in.
I mean, I can share my perspective, but Cindy has some great data on length of stay. So in terms of quantifying what that opportunity really would be, she would be best to speak to that. What I would say is that at a business transient hotel, I think that's going to stick. I mean, there had been some movement to that prior to the pandemic with people incentivizing guests to maybe take points instead of have their room cleaned. I think that is for sure going to stick. At the other end of the spectrum, in a resort destination where people are using their room heavily, I think there's going to be less opportunity to move that. And I think that you probably do want to go into the room if people are going to stay 7 days and make sure that the room's being treated properly, everything's cleaned properly, everything is copacetic inside. But I think on the business transient side, absolutely. On the leisure and resort destination side, I don't think there's a tremendous opportunity for that to stick. I think other areas where you will see some savings or an opportunity might be a transition away from the traditional buffet offering at breakfast. We've seen some of the operators move to hot to go or takeaway, hot breakfast sandwiches, prepackaged bags. I know a lot of the owners would like that to stick for as long as possible. And I think another area I'd really be interested in is, what's going to happen with amenity fees or destination fees or resort fees. While we've had so many of the amenities closed, that was it's not room rate, but it was a fee that you were paying to access things that might not be currently available. How does that get layered back in an opportunity when you're trying to take or push rate higher at the same time?
Just to dovetail onto...
From an operational point of view, just to tie in a little bit on the labor side of things, I think we were already moving in the direction of mobile check-in or robotics, both in the kitchen, in housekeeping. I think we lost so much staff during COVID, and it's been such a struggle to recover, front desk or housekeeping staff. So I think that that we will move, and it will be sustained, the move toward trying to automate some of the check-in, just like the airlines. You check in at a terminal, you don't check in with a person very much anymore. I think we'll have, not that we won't have people, because we want the people interaction, but that doesn't mean that they have to do the mechanics of a check-in. There's a lot of functions that can be automated. So I think that the automation will be accelerated. And I think, my son, another hotelier, has a company called MadeBot, and they're growing in leaps and bounds to do robotics initially to support housekeeping, but the platform is meant to do lots of other things. They're working with RB, the company that makes Lysol, that's actually working with Hilton, to create products that can use these cleaning products and distribute them robotically throughout the operation. So I think that a lot of functions that can be automated, that are repetitive, that are dirty, that are dull, that are hard to get staff to do, will be automated in some way or another. And I think that if we were already moving down that path, COVID accelerated it. But I think from a profitability standpoint, we won't have a choice to do that. And also from a labor point of view, it's just you cannot find the staff in so many markets. We have, this morning I had a call, and it was the GMs were like cleaning rooms and checking guests in. They couldn't look at the data we were talking about. This is just a reality, and it's going to be continually difficult to replace all the staff. And I think automation will be necessary and definitely adopted.
And so disruption always breeds an opportunity for innovation, and it's incumbent upon us as an industry to make sure that we're innovating, not just for cost efficiencies, because what we haven't talked about, which is actually, I think, far more important, is the guest experience, right? During the crisis, we've gotten a grace period from customers that, they're not getting the experience they had before. The breakfast has changed, the outlets are not available, all that sort of stuff. Well, if we really want to be disrupted, then we stop doing the things we do so well, which is providing a human touch, to provide service to customers, and so that's if we go too far down that path, that's really where the risks come in. And as owners, we have to really keep in mind not just looking at the P&L, but the guest experience scores and what's going to drive return business to our hotels, and start when you go home telling your friends, I just had a great trip again, right? And that's not necessarily what people are saying these days, right? I just went to a hotel and I saw a whole bunch of people not wearing masks, and the breakfast wasn't what I thought it was before. We've got to make sure we turn on our best foot forward again, and not just look at cutting costs.
I think if we're selective about choosing the functions that really can and should be automated, and making sure that the human touch is in the right places, I think we can be smart about it. And I think we have to. I think that's a practical way to approach it.
Yeah, no, the innovation is going to come in doing both things really well.
Yeah.
We're running a little bit tight on time, and we're getting fantastic questions in from the audience. Thank you all for sending those. Several of the questions from the audience are going to ask the three of you to peer into your crystal ball and describe the future in terms of when we recover in RevPAR, inflation-adjusted RevPAR, hotel profitability. But hold that for 1 second, if you would. We have some questions about short-term rentals, and several of you submitted questions on that. I appreciate you not calling it alternative lodging because it hasn't been alternative in about a decade or so. But thank you for asking the questions about short-term lodging. The younger generations are more inclined to look for unique and authentic experiences, and that's something that home and apartment rentals can provide very well. How do you see that playing out as far as the level of risk to hotels and the future of the industry? Sort of broad question for any one of you that's feeling brave.
Yeah, there are many things I can't say that I would like to say, but I still represent an organization. I think you said the word can, right? I think the more important thing is what they do, which is they do a great job of showing more of an authentic, localized experience. It's incumbent upon us as hoteliers. We're the ones that actually have people working in the markets. We have real people who work at our hotels that should be providing those authentic experiences. And in some cases we do that really well, and in some cases it's an opportunity for us in the future. I think, oftentimes, whether it's, whatever you want to call this segment of the industry, it's a bit blown out of proportion, right? The valuation of that segment relative to the amount of occupied rooms they have is fantastical, right? And so I think, it clearly this has been an opportunity for disruption. And it's something we have to make sure that we're putting our best foot forward again. But we also should keep in mind, there's a reason why, our rooms are occupied at a much greater level across the globe. And we have, a really strong, loyal following, including in, the millennial segment, which is often believed to stay at those types of properties more than they do otherwise, when that's not actually the case.
So let's talk about recovery timing. We're a little bit tight on time. Let me ask Rachel. I'm assuming you are looking at your crystal ball at the moment. When do we recover in RevPAR? And most industry projections I've seen put it around 2024 for RevPAR recovery. But what's your thought for RevPAR recovery and profit recovery?
Currently, we're in print at 2024. I just would highlight, as any math teacher would tell you, beware of the flaw of averages. I'm sure in middle school we all had you put your feet in the freezer and your head in the oven and your average temperature is just fine, right? And so I think, to Cindy's earlier point, we're going to see a tremendous number of markets recover well before then. And then there will be a few laggards that possibly maybe even were struggling with oversupply to begin with, and maybe had some assets that, like we used to say in the hotel school, were not overbuilt, but under bulldozed. So not everything is pandemic related. I'm going to say, if I had to go, probably slightly sooner than 2024, but that's what we're in print with, and that we will see a large number of markets come back well before then.
Love it. Well, I am sad to say that we are at the end of the hour here. If you all wouldn't mind staying on for just one more minute, could I ask you each for a very brief closing statement, just something that keeps you up at night, or something that's on your mind that we should have talked more about today, or general wisdom for the audience? Anything you'd like to share? How about like 15 seconds apiece, if that's okay? We can go in the order of introduction. So Rachel, I'll put you on the spot here.
All right, I'm going to go with something Jess alluded to earlier. Hotels are not just a physical asset, it's service, service, service. And I'd like for us to think about the opportunity for technology to also drive upsell, meaning, how great would it be if I was sitting at my chaise lounge and could dial up guac and chips and 4 margaritas without leaving my seat, right? How many incremental sales could a hotel drive? How much incremental revenue and profit if we made it easy for the guests to get the experience that they want, where they want it? And I think that layers into the short-term rental idea, which is that they might offer an amazing physical structure, but I know when I go away with my kids, I do not want to be cleaning. I'm already doing that the other 300 days of the year.
Wonderful. Thank you. Cindy, what's on your mind?
I'll give a little bit of a crystal ball what I'm seeing. I think the economics of hotels will be changing as a result of or accelerating what was already underway. I think the soft brands will play a much stronger role in the future of the industry. I think that the big tech players, Google, Airbnb, Amazon, Alibaba, are going to make the OTA participation look like child's play. I think they're going to become very active if there isn't legislative and regulatory action. And I think that's going to further change the economics of hotels. It doesn't have to be bad. It's just going to be different, and we need to be prepared for it. And I think we have to remember that hotels are not, unlike shopping or other kind of experiences, it's not virtual. We may have virtual travel experiences, but hotels will still be a real live experience. And I think controlling that experience and making sure that we as hoteliers control that experience, including technology or not including technology, we just have to make sure that we're making that experience what the consumers want, whether it's short-term rental or hotels or anything else. We have to be responsive to what the market is asking for. And I think hoteliers and the owners who are driving that will use the tools that are available and have more choices to do so in the future.
Wonderful. Thank you. And last but not least, Jess.
Yeah, I mean, I could just simply say ditto to everything was just said. I think to add one more thing, and maybe it speaks to your previous question, Dave. I question the premises of when are we going to return to 2019 levels? That was the last year of a 10-year cycle. I think there's a lot of strength that's going to be coming to our industry in the next couple of years, and if we focus in on the things that Cindy and Rachel just said, it's going to be a very sticky and strong guest experience that's going to power our business into another hopefully 10-year cycle that's even better than this one. And we don't have to get to the finish line in 3 years. We can spend some time getting there.
Excellent. Thank you. Well, let me close by saying we have a ways to go in terms of recovery, the health recovery, the economic recovery, the travel recovery. Having said that, there are some impressive and inspiring green shoots that we see already. And there is a good case to be made for cautious optimism, as we've talked about. In fact, I would even say cautious optimism in the near to intermediate term and aggressive, unbridled optimism for the longer term. Let me close by saying thank you to the hotel school here at Cornell. Thank you to CHR, Center for Hospitality Research. Thank you to eCornell for making this happen. And thank you to our fantastic panelists today. You all were wonderful. Thank you to the audience for joining. Stay safe, be good to each other, and have a wonderful rest of the day, everybody. Thank you.
Thank you.